Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 280th VideoCast podcast for the week ending February 27th, 2025. We've got so much incredible data and information to cover for you today on markets, but as always, family first. This is me and Annabelle at one of her games at Lakewood High School this weekend. And then this is Mimi with one of her friends that plays for UCLA. And what's amazing about this photo is this is just 1 year later. They decided to recreate the photo. You can see Mimi's about 1.5 inches taller. And here she was about 1 inch shorter in just 1 year. It's mind-boggling. It goes super quick. And then I want to thank my friend Jason B for having me back to Big Canyon. I thought I would never get that second call. The first time I went out there was a complete disaster. I had a horrible round. Obviously, we had fun and everything else, but that's not the type of course you want to hack up, and it was atrocious. And this time around, I quasi redeemed myself with a 43 on the front. The back we won't talk about, but it wasn't horrible. And we had an awesome time. Thank you so much. By the way, he's got a tremendous business with Morgan Stanley. Some of you do real estate. He can do a lot of loans. He manages money like financial advisor, estate planning, that type of stuff. So if you want to connect up with him on the West Coast, just reach out to me. He does a lot of the things that I don't do. We just pick great companies and compound capital. He does all of the holistic planning and stuff along those lines. So thank you, Jason, for having me back to Big Canyon. That was just absolutely incredible. I got to meet my friends Philip and Alan came in from the UK and Dubai, right down the road at the Montage in Laguna Beach. They're redoing it. It's just such a gorgeous view. We had a great time catching up. I'm going to go out and see them and their team in Dubai soon, and really grateful for that. Thank you for lunch. It was awesome at the Loft. Get the house salad with the salmon. Highly recommended. And that's that. And then I'm not going to cover, but one of the greatest things, number one, Mimi got a hat trick in one of her games. Annabelle had 2 games and 2 goals. Mimi had a hat trick in the second goal, and hats off to her team who did an incredible job, and her coach Yanya, because Yanya just decided, I'm going to stick her in set, which she hasn't played before, and that's how she got the hat trick. So pretty cool. Here was one of the goals, and then we'll get down to it. Boom. Boom. All right, nice little bullet. That crazy maniac yelling in the background. I don't know who he is. All right, then I got to join Stuart Varney, thanks to Preston Mizell and Christian Dagger, always doing an awesome job reaching out. I really appreciate that, Christian. And this segment proved to be tremendously prescient. And the thing Stu likes to do, and Stu knows what to do because he's got unbelievable ratings, I think about triple what CNBC has in his exact same time slot, is he always likes to ask me what's going to happen tomorrow. And that's a little bit of a pressure on the spot. But you'll see here, it proved to be very prescient. I said that Nvidia earnings would probably be good. The key would be the reaction, and then he puts me right on the spot. So would you buy it here today, or do you think it's going lower? And I said I would not buy it here. I do think it's going lower, and here's why. And sure enough, dropped 8% today. And you're going to find out exactly why, because some of you are probably still confused, even though if you've listened to this podcast, you knew this was coming for a long time. We put out the article on June 20th. It had negative returns since then, and more negative returns after today. So listen in to the great Stu Varney.
The markets, please. Now it's a sea of red. The Dow is off 40, S&P down 30. Look at the Nasdaq go down 1.2%. Check out Nvidia, please. They report tomorrow after the closing bell. They're down 2.4% as we speak. Let's bring in Tom Hayes. He joins me. Tomorrow, the big deal is the call that comes after the release of the numbers. That's what's going to make or break that particular stock. What are you expecting on the call?
Well, that's it. Absolutely right, Stu. Guidance is the name of the game. And the theme of this earnings season has been great earnings and revenue. We had earnings growth of 16% for the S&P, but the guidance was weak. S&P earnings came down from 275 estimates down to 270. Some shops have it below. Nvidia is going to be no different. I think earnings will be good, but the name of the game is going to be guidance. Good news is Mag 7 committed to $300 billion of spending. The DeepSeek did not shake the Mag 7. They said, we're going to spend $300 billion. The bad news for Nvidia is they don't control their own destiny. They are at the mercy of Taiwan Semiconductor, who has limited capacity, which is why 4 months ago, when Intel dropped below 20 on your show, we said, buy it. The government is going to stand them up. They've got a $17 billion revenue fab business. They're eventually going to help Nvidia, but for the time being, their data center revenue growth has been decelerating. A year ago, it was 250%. When you're growing at $4 billion per quarter and the base is getting bigger, by the end of this year, their revenue growth is going to be below 50%. Still sounds good, but when you're trading at 30 times sales and 44 times earnings, sometimes you need to take a break. And that's why Nvidia stock price has had negative returns since June.
So you would not be buying Nvidia at 127 this morning because you think there's a good shot that it goes lower after tomorrow's earnings call, correct?
Correct.
What about Microsoft? They're back to $400 even. Well, what about them?
Look, Magnificent Seven, we've been warning on your show for a couple of months to trim back Magnificent Seven, not because they're not great companies. It's just price is what you pay, value is what you get. And what you have seen year to date is the Magnificent Seven is down 1.5% year to date. Why? Because their earnings growth, again, is decelerating from 33% last year to now it's expected to just be 16% this year because of all the CapEx, because of all the spend without a clear near-term return. And you know the market likes near-term returns, Stu. So that's why, and the multiples are still high, even though the earnings growth is coming down. People are getting wise to that, and they are putting their money elsewhere in the unmagnificent 493 and in international. Yep. European stocks up 10% year to date. Emerging market stocks up 7.5% year to date.
We hear you, and Microsoft is killing me. Thanks very much indeed, Tom Hayes. Great to have you with us. Thank you,
Stuart. And we're back. Moving on. I will be speaking at the Money Show in Miami on May 15th through the 17th. Hyatt Regency Miami. My segments are on the 17th. I'm on the main stage at 12:15 p.m. on Saturday, and then my own room at 1:45. I'll be talking about some turnaround picks and second half outlook, as well as how the uninvestable became investable. So we'll do a breakout on China, which will be exciting. Quotes of the week: the stock market is filled with individuals who know the price of everything and the value of nothing. That's a key theme in what we teach every week here at Hedge Fund Tips with Tom Hayes. In the world of business, the people who are the most successful are those who are doing what they love. That's from Warren Buffett. And if you can't tell, we absolutely love what we do here every week. We call it a treasure hunt. We skip to work and we try to deliver great value. And I think by the responses I'm getting from a lot of you and what you're going to see in the AMA questions, people are really getting tremendous value. This is from W.D. Gann. He says, a successful trader studies human nature and does the opposite of what the general public does. Key is to do that at the right time, not to be a contrarian just to be a contrarian, but to be a contrarian grounded in facts and knowing what you own. Finally, Buffett, we don't have to be smarter than the rest. We just have to be more disciplined with the rest. We always joke. People say, I have ice in my veins, how I sit through these things. It's not ice in my veins. When you know the value of the business and the cash it generates, the short-term volatility does not even remotely impact your thought process. All that impacts is the intrinsic value, the cash generation, where it's going, and then you can hold through those. And then finally is Charlie Munger, another legend, mimicking the herd invites regression to the mean. So if you're chasing the shiny objects that are in the headlines every day, sooner or later, sheep get slaughtered, and we're seeing some of that right now. Okay, let's get down to data, ladies and gentlemen. If you are listening through any of the, first off, I want to welcome, there's a lot of new people listening in last week and this week. I'm very grateful for that, so welcome. If you don't get all the references and inside jokes that we throw out from time to time, you will get it over time. So just hang in there. But what I know you're going to get is a tremendous amount of data. And what I would suggest, if you're listening and walking or playing golf or doing whatever you're doing, keep doing that. It's great. If you can go to YouTube and watch it by typing in hedge fund tips with Tom Hayes, you are going to be able to see this data. And once you get accustomed to seeing data, you will start to notice patterns. And once you master patterns, you will have a clear edge in the market over time. So when you can see it, do it. When you can't, walk and listen. I listen to audiobooks all day long at these swim meets and water polo meets and everything else. So global light vehicle sales. This is related to Cooper Standard, which is an awesome position we're super excited about. As you can see, we are recovering from COVID, and we're seeing it. It's hysterical. Management put out that sandbagger 15.1 million production for this year and blamed S&P for the number. And I said, well, wait a second. How do you get to 15.1 production when estimated SAR by S&P and Cox is 16.2 and 16.3? And they're like, well, there are inventories. It's complete nonsense. The inventories are at historic lows, which we covered last week. And number two, if you overlay production numbers and U.S. sell-through for the last 40 years, it's basically the same line. So all of a sudden, magnificently, there's going to be some divergence between the two. I think not. That's just a play on keeping the OEMs at bay so the OEMs don't come knocking for more margin. So when these things hockey stick, they're going to hockey stick overnight. Here is the data that we referenced with Stu regarding Nvidia. So people are shocked. Why is Nvidia down 8%? It's because their growth rate is decelerating. And that's okay if you're trading at 10 times earnings. It's not okay when you're trading at 30 times sales and 45 times earnings. So basically, and by the way, the one thing I didn't expect that happened is their gross margins are eroding as well. Other than that, how was the play, Mrs. Lincoln? So here's what you see in data center revenues. They have grown $4 billion per quarter for basically the past year. And that sounds great, and it is great, okay? The problem is the base keeps getting bigger, and the growth rate is decelerating. It was 250% off a small base last year, and down this quarter was well below 100%, and will be well below 50% before the end of the year. On top of that, now you have margin worries, you have competition worries, and because of DeepSeek, their edge called CUDA, which everyone thought was going to be the next Apple walled garden, has proven to be not the case. So all they become is exactly what they've always been, which is a commodity producer, and it will be a race to the bottom with margins as more of these inferior chips can be utilized. And as I love to say, the king of inferior chips is Intel. Watch out. Not only will they be able to deliver inferior chips to generate outsized performance like DeepSeek created with inferior chips, but they will be the only game in town. Part of their problem here is not really demand yet, it's supply, and they are depending on the kindness of strangers in TSM, Taiwan Semiconductor. Intel will be stood up. They will absorb some of the excess demand with their fab business. It just won't be in the next couple of quarters. It'll be probably four quarters out, and everyone will wake up and say, wow, Intel is the next Taiwan Semiconductor. I know no one can see that right now. People are like choking on their coffee listening to this, but we've said crazier things that have come true over the last 5 years. Go back and check the tapes, and this will be no different. So here's our buddy Slumer over at RBC. This is the NASDAQ testing this. I think that broke through today. negatively. And then you see the 10-year yield rolling over, which we've been calling for. At 480, everyone says, we're going to 5. And we said, no, we're going to 3 handle first. And I think we're going to hit low 4s and probably high 3s before anyone knows what hit them. Alibaba, which, by the way, is going to ignite the housing market and building and related businesses like Stanley Black & Decker and Generac. Okay, opinion follows trend. Here's benchmark upgrading Nvidia to 190 price target, okay? And many others doing the exact same thing. So effectively what you've seen is a rotation out of expensive US AI plays and into cheap Chinese AI plays. And I think that trade is just beginning. Here is the average path of the S&P during years 1 and 2 of the election cycle. That's going all the way back to 1928. Here we are, about 8 weeks in. You've got this low. We probably rally in March a little bit. Maybe tech gets a little bid. Then we go back and test, and then we rally from the end of March through the late part of the year. That is the average for this year of the cycle. I think next year gets a lot choppier. It is a midterm election year. You come out of the gate strong. You have a lot of weakness into the election and then a year-end rally. So I think we've got a really nice runway here coming, and it's good to pay attention to these statistics and patterns. This is a proxy for what we've been calling for a while. This is just today's chart. What do you see down? All the shiny object stocks, all the Mag 7 are down. Every other part of the market is up. Expect to see more of that. This was super unpopular when we laid this out for you last year, ladies and gentlemen, as you know, and it's happening every single day and people are shocked. Why are they shocked? I don't know. Nvidia data center revenue. Here's the growth rate, that I was pointing to, greater than 250%. Now, we just hit basically here, well below 100%, and by the end of the year, we'll be well below 50%. That's perfectly exciting growth rates unless you're trading at 30 times sales and 44 times earnings. Moving along, here's the Russell, just consolidating here. This is a huge, what they like to call cup and handle. We don't really care much about that stuff, but we do pay attention and we don't ignore it. And the implication of that is that you get a measure move, so figure about 800 points, which would imply 40% above the highs here. And I think this is just getting started. And people say, well, that's a fantasy. You wanted to see small caps go for a while. Well, small caps have gone a lot, okay, for a while. So we're absolutely right about that. And we think it's just beginning. And all you need to do is follow the earnings growth. S&P 500 at 13-14%. And small caps, depending which index you look at, between 21 and 45%, whether you're looking at the small S&P 600 or the Russell 2000. Here is the Hang Seng Index breaking out here from the base, the relative performance of the S&P turning up aggressively. Here's the Hang Seng on a daily breaking out to all-time new highs. My guess is we break higher, go back and test it before making the next parabolic move. Same thing here. Here's what Robert Slumer has to say about Alibaba. Continues to carve out longer-term bottom pattern after rallying 80% from its January low. Baba is likely to start to pause just under its 38% retracement level, near $157. First support is near 120, followed by 105. Yeah, I think we're going back to 120. I don't think we're going back to 105, but I could definitely see this huge base breakout, back test, and then straight up. And probably next stop after that would be 188 or 219. Welcome to the party, ladies and gentlemen. Early days, but if you get a move back to the low 120s and you don't have enough stock, that's probably where I'd buy it. Can I guarantee we're going to go back down to 120 before we take off? No, it might take off. As I said, when we were down in the 70s and 80s. I said, when this thing moves, it's not going to let anyone in. And it absolutely didn't. I mean, straight up 80% in a blink, matter of weeks, and everyone top ticking it at 140. So probably you got to wipe out some of those weak sisters before we go to 200. Here's Nvidia new quarterly revenue growth. We thought even if they did the 4 billion, the stock would be down, and now their guidance is they're actually not even able to do the 4 billion. So this thing is going to trapped a lot of retail investors chasing the shiny objects, and that's the way it goes. History repeats. History doesn't even rhyme; it repeats. I mean, it's just so clear as the sky is blue. Pfizer is interesting, been a notable laggard, but is showing early signs of bottoming in the mid-20s. This one is starting to be interesting in the healthcare theme. So we'll continue to pay attention to that. Regeneron is a proxy for biotech. I think the same story here that Schlumer's pointing out from his technical standpoint, we like from a fundamental standpoint. And I think we're going to see some great things happening with biotech. Crown Castle, nice of him to cover this one. Thanks over there. Notably lagged, but showing early signs of bottoming and weekly momentum moving up, further upside from current levels. We think this goes to 140 over the next 12 to 24 months, plus you get a 7% dividend yield while you wait. They're selling off the capital-intensive, low-return fiber business for over $8 billion to Zio Group. They'll use that to pay down debt, buy more towers, and the 40,000 towers they have require like zero capex. They just mint money. I mean, if you think that Treasury prints money, you should see Crown Castle's primary business is the 40,000 towers. They have to do nothing, and it just keeps spitting out cash. So I want to own that, and when I can do it at a 60% discount from its recent peak, I'm going to do it all day long and collect the big dividend yield, lock that in the meantime. This could wind up being something you own for 10 years and the dividend keeps going up. So you wind up with like a 10-15% yield on your basis and you double your money on top of it. That's what I like to do. Cha-ching, cha-ching. Advanced Auto Parts, everyone's, bitching about the earnings and whining. They're doing exactly what they said they were going to do. Shane O'Kelly came from HD Supply, ran a $7 billion business for Home Depot. Betting on the jockey here. They're selling all the unprofitable stores on the West Coast that are too far spaced out and they have no competitive advantage. They're investing it all in the concentrated areas in the Northeast that they own. They're, hub and spoke model. This will be no different. Take a few years. And, this from these levels, I mean, I think this is triple from these levels. It's probably 24, 36 months. Again, look, all of this is opinion, not advice. Go to hedgefundtips.com and click on terms. Where is hedgefundtips.com? Click on terms. We deal exclusively with family offices and ultra high net worth individuals. Consult your financial advisor, etc. Don't do anything. Think about it. Don't do anything. All that stuff. Disclaimer, disclaimer. This is for educational purposes, etc. Moving along. What I liked here. What is the bull viewpoint after the print? From our conversations, bullish investors believe Advanced Auto Parts continues to make solid progress on many different issues that have persisted at Advanced Auto Parts for years. Moreover, bulls have shown patience and understand the transformation will take time. They believe Advanced Auto Parts is managing expectations to realistic levels. As such, they don't completely understand why the stock closed down. Bulls are confident that after the store closures are done in March and the company turns its total focus to its various growth initiatives, the fundamentals of the business will start to improve. Moreover, bulls were pleased with AAP stated its largest strategic customer renewed a multi-year contract with Advanced Auto Parts and believe Advanced Auto Parts accelerates 2025 vendor conference returning is a good sign that vendors do in fact want to support Advanced Auto Part. Altogether, bulls see Advanced Auto Part as the most levered opportunity to get involved in the auto aftermarket, and as such will benefit nicely when the industry sees improvement. All in, bulls have a line of sight to $4.50 EPS at the end of 2026. You apply a growth rate to that when they're recovering, the market will give them the benefit of the doubt, re-rate it to 18 to 20 times, and then they'll start to do more than that. And if you look at their balance sheet now, since they sold off the Canada business, the name of the game with turnarounds is solvency risk, and they've solved that. They got, I think I looked $1.8 billion of cash on the balance sheet, paid off a bunch of debt, winner as a jockey. So I love these stories. Absolutely love these stories. Here's Nvidia over the last few days, down from 143 to 120. Here's Palantir from 125 down to 84. Shiny object Slaughterfest. These are, for those of you who are wondering, this is a rounding error. Maybe it turns into a big business, but for those of you wondering, Cooper Standard, which is a big position for us, has the sealing systems around the doors, fluid transfer systems, supplies to the OEMs, but they also have this business because of their rubber technology that they just started partnering with Nike on a lot of their high-end sneakers for runners and long-distance runners. So if you Google Nike React X shoes, that rubber is from Cooper Standard, and they get paid a vig on every single unit sold, and it seems like more and more units are being sold. So that could be something that's not even on our model, which would be added whipped cream and a cherry. So keep an eye on that. Rising demand for protection. Open interest in VIX calls has jumped relative to put options. So this is the type of environment that you probably want to stop selling in the hole if you've been doing that, and start to look for things to buy. I think we've pretty flushed out. Here's from Ryan Dietrich. Today is historically the worst day of a weak month during one of the weakest times of the year. So we're probably, and we had warned you guys, second half of February, you can go look at the tapes on Varney, et cetera, expect some volatility, all of that. That has shown up. More sanguine about March, and then following through there. So it's time to deploy some capital. Out of sync, a gauge realized correlation is hovering near the lowest level ever. What does this mean? It means this is the best time ever to be picking stocks and the worst time ever to be in passive indexes exclusively. Speculators further reduce, depending what passive indexes you're in also, speculators further reduce net bullish bets on oil. So a lot of people are selling oil in the hole, which makes me continue to be interested in finding some more exposure beyond Comstock Resources, which has been a home run. So we'll continue to be patient and look for opportunity there, but in no rush. LNG exports rise to an all-time high, which is why we played the natural gas Comstock in the 8s and 9s, and now it's I think it's in the 20s again, and just getting started. The relationship between sell-through and production. So Jeff put this out and basically did the overlay vehicle sales versus production 1990 to 2024. Again, exact same line. In 6 out of 7 cases where annual production deficits exceeded 1 million, production rebounded by an average of 8.5 annually over the next 2-3 years. So there's a huge catch-up even if they're right. If the 2025 deficit holds, this suggests that production could reach 16 million vehicles by 2026 and exceed 17 million by 2027. So in some sense, you hope they're right, sandbagging, because then it's just a hockey stick. But I think they're going to be wrong, and we're going to be up around 16 million production, and they're going to mint a lot of money to the bottom line. And we'll see a couple bucks of earnings, and the market will give it credit for a few more bucks than that. And this thing will start to hum. You know, for those of you who are brand new, they earned, you know, this is a $15 stock. We started our initial positioning and went public on the Claimant Countdown in May of 2022. You can go back to the notes. Built a basis around 550. We've added over time as new clients have come in. Base is still well below 10. And then, so the premise was that the stock on 17.1 million SAR in 2017 peak earned $7.19 a share and traded at $146. They've taken $600 some odd million of cost out of the business. We believe that because of their efficiency now, as the volumes continue to recover, as they do every single cycle, without fail, to somewhere between 17 and 18 million sell-through peak, they're not going to earn $7 this cycle. We think they'll earn it north of $10. And maybe they don't get the 20 times multiple they got to be a $146 stock. But what if they get a 10 times multiple on $10 of earnings versus a 20 times multiple on 7? You still have a $100 stock. And what if they get a 15 times multiple and you got a $150 stock? And God forbid they actually get a 20 times multiple. You have a higher stock than that. So we like our odds, and we like management's execution. The other thing that we have here is, so what Jeff's saying, the cumulative 7-year production deficit of 4.69 million vehicles coupled with record low domestic auto inventories highlight significant pent-up demand and underproduction relative to sales. So, you know, if Besson is successful and I'm right, and 10-year yield ticks below 4, not only does it help housing, we're going to see the financing loosen tremendously on cars as well, and we'll be off to the races. The role of incentives as a leading indicator, we've been pounding the table on this over the past 2 decades. Incentives as a percentage of ATP has averaged 9.8. When incentives exceed 11%, OEMs typically adjust production upward by 5 to 7% within the next quarter to meet anticipated demand. That's from Cox Automotive. Industry estimates suggest incentives could reach 11% by 2027, driven by slower EV adoption and the need to clear out older ICE vehicles. From current levels, this could push SAAR to 17.5 to 18 million units. If that happens, you will not be smiling so wide you could eat a banana sideways. You will be smiling so wide you could eat a watermelon sideways is what's going to take place, okay? And we are waiting with bated breath. So for every 1% increase in incentives as a percentage of ATP, SAAR increased by 400 to 600,000 units in the following 3 to 6 months. Which direction is this headed, ladies and gentlemen? Straight up. That is the number one indicator. We could just end the podcast right there. I mean, I'm so psyched about that. All right. Analysts are raising European earnings estimates. This was not on most people's bingo cards. For those of you who had been listening, we were pounding the table on international, and that's been the lead performers. Discretionary versus staples rolled over. Market got defensive in February. Completely natural. XLK to SPY starting to roll over a little bit. Discretionary rolled over a little bit. Financials softened a little bit. Industrials, energy started to tick up. Materials started to tick up. Healthcare started to tick up, which was the key theme for us. Staples started to tick up. All the defensive started to tick up. Keeping a close eye on the Japanese 10-year Treasury JGB yield. And this is basically a proxy for the carry trade unwind, a lot of which free capital found itself in the Mag 7 as that money is no longer free in the Japanese carry trade. As inflation picks up and they have to raise rates, money is coming out abruptly, and there's a lot of forced selling, and that's going to continue, and that will continue to pressure those stocks and those indices. And the fortunes will be made under the surface by those picking the stocks where price is what you pay, value is what you get. You're getting good multiples for good growth. And that's why Alibaba's up 80%. That's why so many other value stocks we're starting to see take off. Here's the yen carry trade unwind. What's happening? It's moving right back down to those levels that we saw. Share of spending by income group. Top 10% of earners now account for half of spending. You know, this is not news. It's certainly elevated a little bit, but what you see is under Trump 1, this started to normalize, and I think under Trump 2, it's going to normalize. The lower strata did, on a relative basis, the improvement for the lower strata under Trump 1 was orders of magnitude greater than it was for the higher strata, and I think we're going to start to see that. Initial claims for unemployment insurance benefits in Washington, D.C., so they are gutting the public sector. That is deflationary. U.S. apartment deliveries. This is kind of fascinating. So there was kind of a glut, and that's, you know, the cure for high prices is, what they say in commodities, the cure for high prices is high prices. And they glutted the market. So now the deliveries so that will create the setting for a shortage some years out. Mind the gap performance. Here's Hang Seng Tech, dramatically outperforming the NASDAQ 100 on no one else's bingo card except the listeners of Hedge Fund Tips with Tom Hayes, my awesome group here that I'm so grateful to do every week for you. Percentage of stocks in the S&P 500 outperforming the index. So this is starting to pick back up, same as it did in 2001. What happened 2001 to 2007? Again, small caps, emerging markets value dramatically outperform. The regime change is here. It's already happened, and it's going to continue to happen for at least the next handful of years. This bull market might be two, but is still young. So for everyone looking for the exits, yeah, you should have been looking for the exits if you were in the wrong stocks. If you were in the right stocks and paying attention to value versus price and not chasing shiny objects, you're happier than a hyena. But if you're in the wrong stocks and you're saying, I got to get out of everything, keep in mind the average bull market is still young. The average age of a bull market is 5.5 years. We've only been going 2.4 years. The average gain is 191%, and we're only up 71%. Short interest for the typical stock remains low versus history. When's the last time you saw it this low? 2001. What happened the next 5 years? International, small caps, value, all the stuff we love, and China. Higher January and February could mean the bull continues. Stage data from Ryan Dietrich over at Carson. He also has some data here talking about Mondays and Fridays being terrible in 2025. So there you go. Announced buybacks. As you can see, it's shifting. It used to be all tech, but they're now spending that money aggressively and defensively on AI. And that's hurting their margins. It's decelerating their earnings growth. It's decelerating their return on invested capital. And it's limiting their ability to buy back shares, which was a huge driver of EPS growth for many, many years during ZIRP from 2010 till recently. Now financials are starting to lead the buybacks. Healthcare is starting to lead the buybacks. Industrials, etc. So pay close attention. Regime change intact. History of stock market returns can often be determined by whether or not the VIX is above 1950. Historically, the vast majority of S&P gains comes when the VIX is under this level. So that is from Seth Golden. Price to sales for S&P 500. Again, this is super elevated and largely because of the concentration of the Mag 7. That's why we continue to say if you got to be in an index, move to equal weight, move away from overweight Mag 7. And all of them are down now, some 17 to 20 something percent, some even more. And maybe we get a bounce here for sure. I wouldn't be worried about that. But I think the underperformance theme is going to continue. If they're not going to crash like 2000, which I believe they are not, they are going to consolidate. And given the gains that they've had, the consolidation might be a lot more and longer than most people think until they change the index weightings, which S&P always does. Then the indices will start to outperform and these stocks will be a much lower weighting. In the meantime, these type of extremes, you do not want to be on that side of a crowded boat. That is how you drowned. So here is GDP tracking from Goldman, who tends to be more negative than most. They're right around 2%. Baker Hughes rig count going up. I mean, that makes sense why people are selling energy. They're aggressively short. Maybe we can take a quick look at how short are commercials. I did look at it, and I think that they are pretty aggressive. Where's energy? Natural gas. There we go. So what we look at is the commitments of traders, positioning, and we want to generally be on the opposite side of the large traders and hedge funds, and we want to be in line with the commercials. When the commercials are buyers, price tends to follow. Right now, commercials are in fact buyers. It doesn't always work, but it works a lot of the time at inflection points. So our inclination is to be more constructive on energy, but we are in no rush to do it. Here's the Money Show registration. I will be speaking on the 15th to the 17th. Just go to hedgefundtips.com and register there. Love to meet a lot of you in person. Here is from Fundstrat. So they had a similar chart with small caps showing this. They're making the case that we've had a lot of these 5 to 7% pullbacks in momentum, and then they bounce back. It could be the case. So, just be open-minded to that. That would make sense if the indices are going to rebound a little bit in March. But for the long-term gains, you want to start to be moving away from the crowd and skating to where the puck is going to be, not where it's already been in the rear view mirror. Moving along, seasonality for the presidential cycle year 1. Since 1929, February is the worst month. March recovers. April is awesome. May is awesome. June is a little weaker. July is awesome. Fall gets weak, and then you finish out okay. So I think we're going to get a lot of gains in a short amount of time here into the summer, and then we'll probably start to harvest some and look for more defensive opportunities as we get into this window and go from there. Here are the PE valuations relative to history. You're seeing some bargain levels in real estate. What is this PE? Oh, absolute PE. So energy is low, and then relative PE. Here's where you're overpaying is information technology, consumer discretionary looks okay over the last 10 years. Industrials, I think that's probably skewed by a few companies like Cat, etc. But here's where you're finding more of the bargains: staples, materials, utilities, real estate, healthcare, financials, and energy. This was the small cap chart I was telling you about. We agree with this view, but sometimes, look, it comes back up to this top. It consolidates for a little while before it takes the next double higher, gets up to the top, consolidates before doubling to the next level higher. So this wouldn't surprise us at all. And this does look similar to that early 2000s period as well that we've been continually talking about. Bearish sentiment. Well, we'll see the more recent readings. They got completely flushed out. U.S. share of global equity market. So they have 56%, and this is why we've been telling people to get some international. U.S. equities have 56% share of the market, but we only have 44% of earnings. So that is a huge premium for that earnings power. And as you can see, if you look back past 5 minutes, that is not always the case. And they diverge and then they converge. And you don't want to be on the side when they start converging, which I believe they're going to be doing in coming years. Bears argue U.S. exceptionalism has peaked and say 90% of equities are overvalued. I disagree with that statement. But I do believe that you're going to start to see some outperformance in international. And what's going to surprise everyone as they took all the weightings down in China is it's going to be driven by China. And all the hot money that ran into Japan and India to hide in the last few years is now going to come rushing out. FOMO, they're all underperforming. They have no exposure. As a matter of fact, Brendan Ahern of K-Web did a write-up on that. They're all screwed. They missed this 80% move, and now they've got to pile in. Otherwise, they're going to, any international active manager that's been hiding out in India and China is toast. India is at 52-week lows. Japan is it's basically done, and now China has left the gate and not let them in. So they're going to have to panic chase on any dip to buy. And if you get a gift of BABA at 120, 125, and you don't have enough exposure, that's going to be probably your last gift. And I don't think there are any guarantees we get that, by the way. I think pain at this point, it's going to keep pushing higher and forcing people not to be in. And then, at 200, it'll pull back. Everyone will get in at 200 and it'll pull back to 175 and scare the shit out of everyone. All the Johnny-come-latelys that, we're selling at 60 and we'll be buying at 200, and then they'll get roasted. And that's just, it's not to be like mean or arrogant. It's just to say that these patterns repeat over and over and over. And if you understand them, you can say, "Oh, I see what's happening." And especially if you've done the work on the fundamentals. If you're just listening to a guy and not doing your own homework or not allocating, then you got to do the work. U.S. has looser labor regulations and lower unionization. If you build it, they will come. What they're talking about here is, and by the way, some of you were talking about the mic. I bought a Shure mic. It's supposed to be the best one. So in the comments below on YouTube, let me know if there's any improvement this week. I had the Yeti, which was fine. For some reason, it didn't. People wanted to hear it better, so I got the best mic. Let me know if it's better this week or not. I never noticed the difference, but I pay attention to all your comments, ladies and gentlemen. If you build it, will they come? AI versus the late 1990s CLECs, which were the competitive local exchange carriers. The whole thesis was, if you build it, they will come, meaning invest all the money till the cows come home and hope for a return down the road. Sounds very familiar to AI. And they kind of did an overlay of what happened with that thesis. And who was the biggest loser? One of the biggest losers during that period was a company maybe you've heard of. It was called Nvidia. This is what their chart looks like as well. Right here is the index. They're overlaying the semis index over these CLECs. I'm not an enormous fan of these analogs, but I do pay attention to them. Moving along. Here's the antithesis. So they're making the case why this time is different, which is a dangerous case to make, which is better returns for semis versus CLECs. So CLECs were just investing at a loss because they could get unlimited free money during the late 90s. Today, the semis are actually generating a return on invested capital, lower leverage risk for semis versus CLECs. CLECs were 10 times as expensive as today's semis. CLECs burn cash, semis generate cash. So again, that's why we're of the view that we're not going to see a tech wreck. We're going to see a tech sideways consolidation to absorb the gains of, paying for what is going to happen 5, 7, 9 years out today. You've already paid for it. So now you got to absorb it to get a little closer to the event. Buy the rumor, sell the news. You bought it early and you paid full price. So now either the stock, stocks can correct two ways. They can crash or they can grind sideways for a long period of time to consolidate the gains until the event becomes more crystallized to actually be happening, and the time between the expectation of it happening and it actually happening narrows. Investors eager for a pickup in China growth. Which of the following developments would you see as the most bullish for 2025? China growth accelerates. Opinion follows trend. Year-to-date performance in US dollar terms, NASDAQ versus Hong Kong Shanghai, and you can just see the dramatic outperformance. Again, on no one's bingo card at the end of last year, on everyone's bingo card who are loyal listeners of Hedge Fund Tips with Tom Hayes. Global data center power usage by application. So AI workloads are growing. Traditional workloads are also growing. That is great for natural gas, which is why we own Comstock Resources side by side at nearly the same basis as Jerry Jones, the guy who made his fortune in oil and gas and parlayed it into a dynasty in the Dallas Cowboys, which, despite their performance, is one of the most highly valued franchises in football history. Domestic investment is picking up after 10 years of uninvestment, so this is a positive trend for the companies that we look at. Productivity grew at an annualized pace of 2.8% during the tech boom versus 1.6% in the 2 decades after. This is beginning to pick back up. Labor productivity, you can see here, we've been consolidating for 18 years. We're now breaking out, and we're going to start to see massive productivity like we saw in the late 90s and in the early 2000s. Consumer sentiment has been weak on fear of tariffs and inflation and kind of the uncertainty of new volatility every day with a new announcement. Welcome to Trump 2.0, same as Trump 1.0. New day, new policy, new tweet, new volatility. Get over it. If you don't know what you signed up for, that's what we got. And I think that you got to break a few eggs to get an omelet. So we're in the egg breaking process, and I think we're going to get some beautiful, big, beautiful omelets come out of this. University of Michigan inflation expectations through the roof. Why? Tariffs. University of Michigan 5 to 10 year inflation expectations. Same thing, tariffs. If you look at the data, you get a short-term bump. Intermediate term to long-term prices are actually lower because growth tends to slow as well. That's also deflationary. S&P Global U.S. Manufacturing PMI actually turned up. Dallas was terrible, but Philadelphia was good. So you're seeing mixed, but generally moving in the right direction. Mortgage rates are coming down now below 7%. That's positive. Stanley, Generac, etc. City Economic Surprise Index turning down. So we got to keep an eye on this. You did see a little bit of that in late 2023 when everyone was calling for a recession that never came. So be mindful, but don't be paralyzed by it, is what I would say. Dollar rolling over, part of our core thesis. Yields going down, part of our core thesis. Non-commercial, selling in the hole, which is why we're starting to get more and more interested in oil and oil-related stuff again. Here's the seasonal composite taken not back to 1929, but back to 1994. And here we are in February, late February, early March, things pick back up. I think that is a good model to keep in mind. So be ready in the first couple of weeks of March for things to look a lot better. Doge effect, federal redundancies are rising. So, this is a lot of layoffs. We haven't seen that since 2022. E-commerce retail sales as a percentage of total sales hit a record high, now almost 16.5%. That's bigger than during COVID when everyone was locked down. So that's a positive thing for things like Etsy and others like Baba. Biggest inflow to Europe in 3 years. Opinion follows trend. Japan CPI turning up, which means what? They have to continue to raise rate, which means what? The free money of the carry trade is over, which means what? Forced selling in Mag 7 and passive indices that are overweight Mag 7. Japan CPI, there we go. Core inflation hits 19-month high in Japan, keeping alive BOJ rate hike bets. Alibaba straight up. Alibaba daily return straight up. Hang Seng relative to Hang Seng Tech dramatically outperform. And that's what we had said probably a year ago on the podcast. We said that when, if the Hang Seng doubles, the key stocks will be up triple, or quadruple. And by the key stocks, we mean the Alibabas, et cetera, and that's just begun. Short interest is still record high in China, which means there's going to be a lot of forced buyers in coming months. These were core part of the thesis as we were laying it out when everyone was very negative on China and dollar rolling over. The yuan is strengthening relative to the dollar, which no one thought would happen. And guess what? China bond yields are going up. Two things that you see every cycle when Chinese equities take off. Here's India. People couldn't get enough in 2024 at the peak. Now it's rolling over. Everyone's selling in the hole. If you remember all the articles, record call options in India's history, it was unbelievable. They were like doing more options than the United States, and they're like so much smaller, economy and markets by capitalization. And those are all the telltale signs. And people, this chart is actually accelerated into, it broke through on the downside. If you remember, we covered this last week. It's actually broke below this, so it's a whatever they call it, a bearish pennant. So keep an eye on that. Insider transactions is actually at a level that's contrarian bullish. We're actually even seeing it in Cooper Standard. Insider buying, we're going to cover later in the podcast, first time in a while. Here's the treasuries. We've been saying bonds up, yields down. Here's the short interest. These people are going to get smoky smoked. They haven't been this short since 2018, 2014, right before monster rallies in bonds. Tequila is the only spirit seeing sales growth in the U.S. Diageo has a lot of tequila. and good tequila brands. Staples versus the market. Haven't seen this since 2000, early 2000s. Again, another factor that is rhyming with our 2001 to 2007. A lot of similarities. China outperformed, small caps value, and staples. So pay attention to this. This is an extreme opportunity here, and we've got some expression through Hormel, but we're going to find some others as well. Growth versus value in the last couple of days. Growth rolling over, value rallying. This is from Thomas DeFazio, the son of my friend. Had a chance to have lunch with them about a year ago. And so hello to Bobby and Thomas. Thomas is putting out the Russell 2000 back to support at the 200-day moving average. Not quite oversold, but a bounce could be in play here soon. We agree. Good work, Thomas. Here's Bobo breaking out of the basing pattern here. Measured move would be from 60 to 120, takes us up, first stop 180, and then I think we consolidate before going even higher. Dollar rolling over as anticipated. What do you think the headlines were here? Dollar will break to new highs, and of course, everyone crowded in at the exact wrong time. Here's the stock market performance since the election. Everything we said would be taking place, that everyone would be shocked, international would start to outperform, and sure enough, that's been the case. S&P is basically flat now. Stocks have trailed international peers. U.S. stocks, AAI bull-bear spread touches the lowest level since November 2023. So sentiment is getting washed, so be ready for a big bounce. Don't know what the catalyst will be, but I'd be shocked if we didn't get one in March. Big rally of some areas. Magnificent Seven stocks sink while defensives race ahead. Healthcare, staples, Mag 7 down 6-7%, while these are up 6-7%. On no one's bingo card, unless you were tuned in to Fox Business when I was talking with Cavuto at the end of the year before he retired, and I said, the last shall be first. Watch out for materials and healthcare were the worst two in 2024. Everyone was like, no way, man. It's going to be Mag 7. I said, no way, man. Watch what happens. And sure enough, the price followed the earnings growth, and we're off. These earnings are decelerating. These earnings went from flat to 20%, and surprise, surprise, the price followed. CBOE skew index soars. You have to pay attention to this. We've covered skewed many times on this, but you buy protection before a fire, not in the middle of a fire, and I think we've done a lot of damage under the surface. A lot of these momentum, crowded trade, shiny object, popular stocks have gotten completely smoked. And I think we're getting closer to the end of the liquidation than the beginning. 10-year Treasury yield rolling over. Discretionary looks like it could potentially be ready for a bounce in coming weeks. Staples might be a little overdone in terms of the defensiveness. Expectations for cuts are now going up. People are pricing in slower growth with the tariffs, and yields are coming down. Fed cuts expectations going up. Here is some of the Mag 7. This was a couple of days ago. These are looking a lot worse now. Most of them are down about 20%. Tesla maybe a little more. Nvidia got hit a lot harder today. February is the worst month of the year in post-election year. Second half of February, all these stuff that you were ready for now has played out. Not a lot of debt, but delinquencies are rising from low levels. So again, these are historic low levels of debt. So yes, you will see delinquencies, but it's off a very, very multi-decade historic low base. Debt service much less of a burden now. A lot of debt was locked in at very low rates. Consumer confidence, a little bit grinding sideways. We saw that actually right before the first Trump administration. I think you're going to start to see a reacceleration just like you did in Trump 1.0. Here's the breakdown of the Mag 7 from Mike Zaccardi. You can see this pennant actually broke down below the volume by price as well. which implies it could see some more pain for those overweight stocks, and which, wouldn't be surprising, but we're not stepping in. That's not our game. We've got what we love, and they're doing well. I mean, I can't tell you the amount of days that the market was getting smashed in February that our P&L was positive. I've never seen anything like it. It was just unbelievable. Mag 7 expecting superior earnings growth versus 493, but it's cutting and it's decelerating. That's the big deal. Unmagnificent 493 is accelerating. That's why these are going to outperform and those are going to underperform. Here is diversification is paying off. What's the top performing year-to-date equity return versus the U.S.? China, followed by Spain, Italy, Germany, Switzerland, France, Mexico, Nordics, Netherlands, UK, emerging markets, and Japan is actually doing worse. Everyone couldn't get enough Japan last year and the year before. Value underperformed growth in the post-Great Financial Crisis decade, but it has been more mixed since then. It is bottoming just like it did in the early 2000s. Why? This was an aberration called ZIRP, zero interest rate policy. It was the only decade in 100 years where if you could buy a basket of stocks trading at 10 times sales and outperform the S&P 500. Any other decade you did that, you'd lose 80 to 90% of your money within 48 months. This will not happen again. Unless you think rates are going back down to zero, then I wouldn't be playing that bet. The name of the game is value has outperformed growth by 4.4% since 1927, which basically means if you put $1 million up at that period and invested in value over growth, you'd have an extra $68 million of gains. And that includes this aberrational 15-year period where it underperformed because of unnatural manufactured conditions of zero interest rate policy. Fed funds target rate, covered that. Texas was weaker, Texas manufacturing, but Philadelphia was better. GDP, so this is consensus, is going up to 2.3. That's not the type of environment where you see a recession. Household consumption is expected to grow. Consumer discretionary got shellacked here in February. There's going to be some opportunities in that rubble. Here is tech relative to the S&P 500. This is what they call a rounded top or a head and shoulders or whatever. It really is useless thing, but worth noting, I think, on a relative basis. Okay, it doesn't have to crash, but on a relative basis, I think we're going to see continued outperformance. This is not good if you're overweight in passive indices that are weighted to the Mag 7 or in the Mag 7 names themselves. This is not a positive development you want to see. Maybe it will be a fake out and then we get that rally in March, which is fine, but here's the positioning. Everyone is crowded to one side of the boat. You can see it here. We had a ton of data this week. Here is the bond starting to rally. Here's a reverse head and shoulders bottom, which implies a massive rally like we saw in 2018. Here's bearish sentiment. This is the AAII percentage of bears. We have only seen this 2 other times since 1986. Both were at or near 3 times major bottoms. You saw this level of pessimism in the COVID lows. You saw this level of pessimism during the Great Financial Crisis lows. And you saw this level of pessimism during the early 90s recession, which was caused by a banking crisis. And if you remember the Orange County real estate crisis when the Japanese money all pulled out, I will be interested to see what happens with Orange County real estate in the next few years as Chinese money stops flowing out of China and stays in China due to fear of loss as everything else starts to go back up in China. And you see more and more price cuts in Orange County. It could be very, very interesting. And what else do you have here? VIX we covered. Richmond manufacturing was good. SOM rule at the state level, we got to keep our eye on here. Possible signal of recessions. This is probably somewhat skewed by Washington, D.C., so we'll keep an eye on it. Covered 10-year bond yields. Bitcoin has also gotten shellacked down to 85,000. That kind of qualifies in the speculative bucket that we talk about a lot. So that's getting hurt. Here's the bull bear spread again. You saw this level of pessimism at the 2022 lows. If you remember, that's when we were buying Amazon and Google deep in the hole when no one wanted it. Quick doubles within it was like a year. So I think there's going to be really incredible opportunities in the next few weeks to be able to benefit as well. This is unbelievable pessimism coming out. TLT bonds starting to dramatically outperform S&P 500 in line with our themes for the year that you all know. It's really exciting when you see all the pieces coming together. As we had said in some of the foggy times, I said, hang in there. When it comes all at once, and we are seeing that in spades. Potential 1.5 trillion savings over 30 years from GLP-1s. I mean, you speak about productivity. If they get GLPs down to, $100, $200 a month, which they already have generics, and they continue to do all the things, every single insurance company is going to sponsor them. People are going to get fit and healthy, and it's going to save trillions of dollars of healthcare costs if this continues at the same pace, which is pretty exciting. Fewer jobs expected in the next 6 months. So a lot of pessimism and uncertainty. That's normal Trump 1.0 manifesting in Trump 2.0. And the outcomes of 1.0 were very, very good for the average worker. Minorities, working class people did really well. Real wages did great. Conference board, CEO confidence ticking up. Again, this is what you saw in 2001. It's what you saw coming out of the great financial crisis off a very low base. This is actually very positive. If I didn't mention yields going down, let me just mention it one more time. Mortgage rates going down. That's good. China to start bank recapitalization with at least $55 billion. M2 money supply in China turning up. This is a big precursor to massive expansion. Magnificent Seven slides into correction territory. The basket is down well over 10% now. Tesla is down from almost $480 down to $300. So it took its post-election rally back, at least 60% of it back. And we'll see how that plays out. Growth versus value. Growth is getting shellacked. I think this trend is going to persist. Value is going to be performing. Lots of money going to be made in value. The right value, not value traps, but companies with growth, with cash flow, growing, turning around, that type of stuff. U.S. stocks are now lagging the rest of the world. Here's the news story count for firings, job cuts, and layoffs. Haven't seen this record since late 2022. That was a massive buying opportunity. Analysts are raising European earnings estimates. Microsoft data center leases are slowing, analysts say, raising investor attention about demand for Nvidia's products is basically what it comes down to. Again, after the AAII bull bear falls below negative 40, where it is right now, 1 week later, the market's down on average 1%. 2 weeks later, it's up 14 basis points. A month later, it's up 2%. 2 months later, on average, it's up almost 5%. 3 months later, 6%. 6 months later, 13.7%. 9 months later, it's up 19%. And 1 year later, it's up 22%. So this level of pessimism may, in fact, prove to be a very positive thing once the bottom's in. Cycle composite, this is where we are right now. Expect more rockiness into early February and then straight up from there. So a lot of things pointing to the same outcome. Most stocks are trading, this is from Seth Golden, most stocks are trading at their lowest correlation to the index or each other than at any time since 2021, which dampens the index ability to break out and or move with any meaningful momentum. It's a stock picker's market, folks. This does not support double-digit returns in 2025. We tend to agree. I think the S&P is going to be, as we said, fourth quarter last year, it's going to be like a 7 to 9% year, S&P 500. And I think absolute unbelievable fortunes are going to be made under the surface for people positioned in the right way and in the ways that we've been talking about for many weeks and months. Bull markets in the S&P 500, 1957 to date. What you're seeing here again is the average gain is 145% in 52 weeks. We are only at 71% in 28 weeks, which means there's a lot of runway left. We agree. As a reminder, growth versus value. This, ladies and gentlemen, ZERP right here, where growth outperformed value, that is the exception. This, ladies and gentlemen, the red, where value outperforms growth, is the rule. Okay, 4.4% compounded since the late 20s. If you get positioned on the right side of the boat ahead of the crowd, fortunes will be made and are already being made, ladies and gentlemen. Wink, wink. All you guys with eating your bananas sideways know what I'm talking about. US dollar index. I like this cycle index on Twitter. I don't know who this is. Jason P. I think this is correct. These things run in cycles, and you can see here, what is it? I don't know what this is. It's probably an 11-year cycle or something like that. They're not perfect, but they're always worth noting. Covered that. Initial claims in Washington, the highest since 2023. Also is ticking up nationwide, so worth keeping your eye on. That is deflationary. Everyone's worried about inflation, worried about deflation. 10-year yield, that's from Zaccardi. Here is from Almanac Trader, kind of pointing to the same thing. Little weakness in early March, and then we start to take off. That's that for the data. Let's go through some headlines, and then we'll get back to the Ask Me Anything questions. We're just giving data like it's going out of style this week. Very exciting stuff. China developers buy land at 20% premium in bet on market bottom. What a difference a few months makes. This Chinese AI bet has outperformed Magnificent Seven names like Meta and Google this year. They're talking about Alibaba. I mean, opinion follows trend. Alibaba's core business, reignite growth as AI strategy, delivers strong results. We saw that. AI-related cloud products delivered triple-digit year-over-year growth for the sixth consecutive quarter with strong growth momentum ahead. They are getting a return on their invested capital, unlike the Mag 7 here that are just spending money like crazy and have yet to see returns. Doesn't mean they won't come, but you're probably paying for returns that are tenuous at best. What does Jack Ma's return to the spotlight mean? It means the game is back on. There's Xi Jinping shaking hands with Jack Ma. 2 years ago, they wanted to hunt him down, arrest him, and kill him. Now they're begging him to come back and turn the country around, and that's exactly what happened. He is the poster child of innovation and all things positive in China business. And they just realized with protests spiraling out of control last year and the year before, it's time to make a change. Like all politicians, their number one job is to stay in power, and that was starting to be a coin flip, and they pivoted. But to Xi's credit, he can take a lot more pain than I anticipated, but eventually he had to blink, and he absolutely did. Why Xi Jinping is making nice with China's tech billionaires, I'll give you one word answer: survival. Ant Group hires for development of embodied intelligence humanoid robots. For those of you who forgot, 90% of the people chasing the price don't know. As owners of Alibaba, we own 1/3 of Ant Financial Group, which is the largest financial services company in Asia, and that will wind up being IPO'd, and we will get a huge slug from that as well, which is probably not yet priced into the stock. Here's the article from Ruchir Sharma. Is China investable again? You couldn't believe the number of articles in the Financial Times calling China uninvestable when Baba was at 60, and now it's investable at 145, and it will be the best investment ever at 250. Mark my words. And we will be helping people out as they all crowd into the boat, begging for shares of China stocks. We will help them out and give them as many of ours as they want. A Chinese alternative to the Magnificent Seven has arrived. This is kind of funny. My buddy Lou Bassanese is the featured picture for a Bloomberg article about how good China's doing. So I was joking on our text group that the Bloomberg bot must have just Googled, find me the most handsome commentator. And of course, they all came from Fox Business. So speaking of which, here we go. This is Dan Ives on CNBC this week after Baba was up 80%, saying that Alibaba will be the big winner when it comes to AI in China. I couldn't agree with him more. And super nice guy. I've had a chance to meet at some of the money shows, and it's nice to see him start to get behind it now that it's working. Xi urges officials to stay calm as U.S. raises pressure on China. So at this point, we've covered all the impact on GDP if Trump does the worst possible. And the market is really just shrugging it off at this point. It's already priced in a lot of the worst. And I think it's going to be a case of sell the rumor, buy the news. Ant Group's profit rises with Jack Ma back in the public eye. Fintech firm saw profit jump 50-fold on investments. Ant made 13.6 billion yuan in profit for the quarter. Again, we own a third of that. Alibaba makes Sora-style video models open source as tech giant shows AI capabilities. We all know that Qwen 2.5 smoked OpenAI and smoked DeepSeek on most metrics, and that's why the stock is cranking. Alibaba to ramp up AI cloud computing investments as quarterly profit surges 239%. Alibaba's AI bonanza, China comments, and Premier Li on raising domestic consumption. Here is from my buddy Brendan Ahern, who runs the K-Web ETF, China Tech ETF, and is a phenomenal golfer. Could Ant go public? Maybe. Ant added $618 million to Alibaba's bottom line. And what else did you possible? Yeah, Trump's talking about having a good relationship with Xi, though. I think you may have noted this week in that live press conference. I'm trying to see the line that I wanted. Boosting, quote unquote. Premier Li presided over a state council meeting. The key point from the statement below is that it gives an indication of policies coming out of the dual sessions in early March. Pay attention to this, guys. In poker, this is called a tell. This statement has the potential to have significant implications. I didn't know you were a poker player, Brendan. We got to sit down and play. Quote, boosting consumption is an important starting point for expanding domestic demand and stabilizing growth, but also a major measure to change the medium and long-term development mode. We should put consumption in a more prominent position and rely more on boosting consumption and to expand domestic demand, smooth the economic cycle, and stimulate economic growth. We should make every effort to enhance consumption capacity, adopt more effective consumption promotion policies, break the barriers and constraints restricting consumption, and make every effort to optimize the consumption environment and to strive to open the chain of consumption, driving investment, industrial upgrading, employment, and income increase. Look, the number one toll taker for consumption in China is Alibaba. Okay, they're the largest online retailer with Taobao, Tmall. If this is the direction the government wants to go, no one is going to be a bigger beneficiary than Alibaba. So the game is just beginning. Ryan Cohen boosts his Alibaba stake to $1 billion. Palantir insiders keep selling shares after $4 billion windfall in 2024. So just like Jensen Huang filing to sell $1 billion in June when we put out our article, basically which marked the top in the price, had negative returns for the subsequent 6 months, filed to sell 1.2 billion. Alex Karp is doing the exact same thing. The Palantirians can't get enough stock, and you know what? He's going to help them out and dump billions of dollars of shares on their head as they all chase the shiny object and ignore what's going on. Mar-a-Lago Accord chatter is getting Wall Street's attention. This is a big deal. So, two things that they want to have happen. It's going to mimic what happened with the Plaza Accord in 1985. It will be called the Mar-a-Lago Accord. Of course, it will be a big, beautiful deal. The dollar will weaken, which helps what? Which helps our emerging markets and China trade. And it will, there are two aspects. Number one, weakening the dollar. And number two, they're floating, swapping some of their treasuries into 100-year non-tradable zero-coupon bonds. If these nations needed cash quickly, the Federal Reserve could make it temporarily available to them through a lending facility. basically swapping it out for paper, which would eliminate the carry or the negative carry on paying out the interest payments. And lower the debt to GDP because the zero coupon trades at a huge discount. I mean, if they could pull it off, what we'd have to give in exchange for them to take the swap would be very interesting. But some institutions will want it so they can hold the marks on their books as at par. If they actually pull this off, this will be the greatest trade of all time in terms of, I mean, trillions and trillions and trillions and trillions of dollars saved for the U.S. So that said, the other thing that they announced is selling the golden visas for $5 million a pop, and they could raise a quick trillion or $2 trillion. I'll tell you, if they want to raise the quick trillion to $2 trillion, what they need to do is put an expiration date on it and say, we'll sell these visas for $5 million a pop for the first 12 months. After 12 months, either A, it's going to be discontinued if we're oversubscribed, or B, it's going to be up to $10 million from that point forward. So get all these $5 million in. I mean, they could get a trillion, $2 trillion bucks into the Treasury super quickly, and that would be something, again, that was on no one's bingo card at the beginning of this year. So pretty exciting stuff. All right, let's keep moving. Got to move this button here. Okay. Besant and Republicans in Congress kickstart tax cut talks. I mean, these guys must be working literally 24 hours a day. The amount of things that they have going. So some deflationary with Doge, which is a good thing. Some unbelievable restructurings with the Mar-a-Lago Accord, then tax cuts on top of it, then tariffs on top of it. I mean, it's unbelievable what's happening. Hard to keep up, which is why this call is so long this week. But you got to know what's going on because in uncertainty is massive opportunity. And by staying on top of all of this, that's how we benefit from it and how we find these windows of generational opportunity consistently. And we're doing the exact same thing right now. And many of you are as well, based on your comments and beautiful feedback. So Europe's earnings outlook brightens as U.S. wobbles. Intel's foundry is a proven problem. Why this analyst has raised his price target. This is from Mizuho Securities, Vijay Rakesh. So he's seeing some silver linings. Bundle of Disney Plus, Hulu, and Max has a stronghold over viewers. It's even stickier than Netflix. Couldn't give away Disney in the 80s. All the pessimists were saying woke, broke, nonsense. And now the thing's up. It's just getting started. Intel unveils Xeon 6 chips, doubling AI performance and powering the next generation data centers. You cannot sell this headline anywhere. No one is interested, which is the exact time you want to be owning it. Warren Buffett offers lessons on investing in his annual Berkshire Hathaway letter. And what he said, which I wanted to cover, is okay, I promise. Effectively, what he's basically showing is you want to be an owner of equities, not of cash, even though his positioning currently is not that. If you look through history, when he gets his cash so high, people think that's immediately a reason that the market's going to crash. You don't know why he's raising that cash. For all you know, he could be preparing to do an elephant-sized deal of a business that maybe he's wanted for a long time. Maybe Mars is for sale. I know he's wanted that for a while. You just can never tell, but it hasn't been a good indicator in the past. PayPal Investor Day touts profit roadmap, Venmo monetization, and merchant platform. Jefferies starts coverage with Stanley Black & Decker with a buy, sees 20% upside, being very conservative. It's the best leverage play on the housing recovery as rates drop below. A 10-year yield drops below 4%. Mortgage rates come down to a high 5 handle or a low 6 handle. It's going to go bananas. PayPal has some big new growth targets. Can it hit its marks? I'll answer the question yes. PayPal sees earnings growth as firm, streamlines business. Adjusted EPS seen climbing 20%. Palantir stock falls again. Why its losing streak won't end. Cutting defense spending is one reason. Dumping stock on your head is another reason. Valuation is a final reason. Price is what you pay, value is what you get. Even if this thing is curing cancer, it's paying. If they announce tomorrow that they cured cancer, I think it's probably still overvalued. And they don't do anything like that. Trump says U.S. will sell $5 million gold cards. Green Public just put an expiration date and watch the money pour in. Make them a Mar-a-Lago Accord they can't refuse. We covered that. Why? Xi Jinping, China tech companies backing from the cold. MicroStrategy stock stumbles. The value of Bitcoin hoard is falling, and he has massive leverage relative to that other asset. There is a number at which all hell will break loose for that business and that stock. I don't know that we'll get to that number, but you can Google it and pay attention for those who are watching with popcorn. Effectively, what this guy has done is continue to issue debt to buy Bitcoin. And we've seen movies like this before. They've written books about movies like this. White House orders agencies to prepare large-scale staff cuts. That's more deflation, not inflation. Nvidia warns of growing competition from Chinese Huawei despite U.S. sanctions. 10-year Treasury yields ends at near 11-week low. Bond year slide hits dollar. Yes, it does. Popular momentum trades like Palantir and AppLovin are unraveling. Don't expect them to bounce right back. Yen traders raise focus on Japanese data as economic shifts gears. Strong Japanese data may lead to more gains for the yen. This is what we were pounding the table on in Q3 and Q4, and here it is. Nvidia sinks after more subdued growth fails to wow investors. You heard it on Stu Varney 2 days in advance. GM hikes dividend and unveils stock buyback plan. That's not the kind of thing you see in a pessimistic outlook for U.S. production. Lowe's stock is rising. Home improvement might be turning the corner. Most leverage plays on that are Stanley Black & Decker and Generac in our view. Japan's, which we own. Japan sees fewest births on record, deepening demographic crisis. People can't get enough Japanese stocks. Good luck. Boeing makes a management change. It could be the key to profitability. So they got rid of Stephanie Pope, who was COO, got someone in there that's more aligned with Kelly Ortberg's can-do attitude, created a 4X, four-bagger in Rockwell Collins in 7 years at his last turnaround. This one's going to be fantastic. Couldn't give it away at 135. No one still wants it at 170, 180. So there you go. Still opportunity. From left for dead to loved again, stock market and sentiment results. We got, wow, this is we're rocking and rolling here. Jeff did a great article here, put together all of our themes, and basically started with the last shall be first healthcare edition. Back in December, we published a weekly article entitled Healthcare Left for Dead. You can find the article here. Then joined Neil Cavuto on Fox Business to break down our healthcare thesis. Listening here, at the time, the anticipated appointment of RFK Jr. had rattled the healthcare sector, with 62 healthcare components of the S&P down an average of 19% from previous highs. This was the latest chapter in healthcare's ongoing struggles, marked by its worst period of underperformance relative to the S&P 500 since at least 1991, and its lowest overall weight in the index, around 10% in over 25 years. However, over roughly the same period, total U.S. healthcare spending more than tripled, rising from $1.4 trillion in 2000 to $5 trillion in 2024. You could see the underperformance when we were on at the end of the year. What made us even more curious was that despite the weakness, the sector was and remains projected to achieve the second highest earnings growth in 2025, expecting a 19% increase compared to the S&P's 12.7. Same thing we talked about with materials. Remember, in the short term, the market is a voting machine based on emotions. In the long term, it is a weighing machine driven by fundamentals. So 2 months into the year, how are things playing out so far? Healthcare is the number one performing sector. Technology, negative. Consumer discretionary, negative. Healthcare up 7.3. Materials up 5.3. S&P up 1.73. Healthcare is the top performing sector, outperforming the S&P by 4.2 times. Looks like the rumors of its death were indeed greatly exaggerated. The reports of my death are greatly exaggerated. That brings us to this week's first focus, Baxter International. For those who have been with us for a while, you know Baxter represents a large portion of our healthcare exposure. And as you can see, this thing has done the same thing over and over for 40 plus years, and they've been around a lot longer than that. This is just the price chart. It gets oversold every cycle. They work through the inventory. They recover because they have durable moat in their products. As you can see, the price fell for a reason. Cash flow fell. They overstocked. They did a dumb deal with Hillrom. They then sold off some of their drug business, raised a ton of cash, paid down debt. Now the cash flow is going to start to hum again, get back to growth, and we are off to the races. Sold off the kidney business. I'm sorry, I got confused with sold off the kidney business, which was the lowest growing business in the firm, which put pressure on the multiple. Now that slowest growing division is gone and they've used the cash to pay down debt, earnings are going to increase, and then you're going to get a multiple re-rating from low double digits to probably closer to 20, and then you're going to get the growth back, and this thing is going to be a double and more over time, and we're pretty excited about it. So you should go through all these points that he underlined and starred, as we do every week, with different companies, and see why we're confident in our position and we like this moving forward. So they divested the lowest margin, slowest growing business, which was the kidney care business, and got good money for it. You can see the PE is depressed. Because of that, it's going to expand back to, this is traded, at 13 times now. It's been as high as 30 times, 25 times. Every cycle you get these peaks, and this time will be no different. So go through this. Last shall be first, China edition. For almost 3 years, investors wanted nothing to do with Chinese equities, with headlines week after week calling China uninvestable and stuck in a secular bear market. Foreign purchases of Chinese stocks dropped to an 8-year low in 2023, with the prior low in 2015, which turned out to be a generational buying opportunity. Meanwhile, 89% of global active funds held less than 5% allocation to the world's second largest economy. So here are the headlines. We went through hundreds from that one author at Barron's every single week. I think she's been fired. I haven't seen an article from her since Alibaba went up 80%. She'll be reassigned. That's what they always do. Like a priest, send them to another parish. Foreign purchases of China stocks dropped to 8-year low in 2018. Last time it did this preceded a monster rally in 2017 and 18, and we brought this chart to you. While most were running for the exits, we saw the disconnect between price and value as an opportunity. Wall Street is the only place when they hold a clearance sale, everyone runs out of the store. For those of you who've been with us for a while, we've expressed our China exposure through one of our favorite stocks and largest position, Alibaba. We started buying in the hundreds and backed up the truck in the 60s, giving us a blended cost basis in the low 80s. As part of our original thesis on Alibaba was that the performance and fundamentals reminded us of Microsoft from 2006 to 2013. During that period, Microsoft saw revenue up 112%, cash flow per share up 200%, earnings per share up 120%, but the return on the share price was 0% over 7 years. Then a switch flipped, and Microsoft went on to deliver nearly 1,500% returns over the next 7 years, 36% CAGR. And if you look at the underlying fundamentals of what revenue, cash flow, and earnings did over that period, it wasn't much greater than when the stock gained 0%. Everyone thinks Satya did these miraculous things, but the performance of the fundamentals was not that much greater under Ballmer. Ballmer actually created the foundation. So he missed mobile. Can't take a joke. But leaving that aside, it goes to show you when you hold the beach ball underwater long enough, eventually the catch-up is abrupt and it is massive. And Alibaba will be massive. Okay, fast forward to Alibaba over the past decade, it's even more pronounced holding the beach ball underwater. Revenue per share up 1,100%, Cash flow per share up over 500%, earnings per share up over 500%. Share price was up 10%, with mostly negative returns compared to 2014 levels before its recent parabolic surge, and just beginning. You can only hold a beach ball underwater for so long, and sure enough, the world seems to have finally woken up to the fact what we've been pounding the table on for the past 2 years. Alibaba is the number one play on the recovery of China's middle class, the number one cheapest global AI play, and essentially a China AI ETF. Alibaba then went on to report blowout quarter last week, and now it's all anyone wants to talk about. If you were wondering what we mean when we say opinion follows trend, look no further than the upgrades below. The stock was hated in the 60s, 70s, and 80s, but now at 140, investors can't get enough. Morgan Stanley overweight moved their price target from 100 to 180, up 80%. Benchmark moved it from 118 to 190. Bernstein moved it from 104 to 165. Barclays moved it from 130 to 180. JP Morgan moved it from 125 to 170. SIG, I guess that's Susquehanna, moved it from 130 to 175. Nomura moved it from 130 to 172. Bank of America from 117 to 150. Dan Ives went on CNBC calling Alibaba the best AI play in China and presenting his base case of a valuation of $500 billion market cap. Base case $210 per share. We agree. Not only are sell-side analysts turning bullish, but mainland investors via the Southbound Stock Connect program continue to pile in. The total ownership of mainland investors now sits at 6% of the float, which we believe to still be in the early innings. Analysts had initially projected $20 billion of inflows before the parabolic move, and with peers like Tencent and Bilibili having 10 and 15% respectively of their float held through the program, these inflows still have legs, and massive legs thereafter. Here are a couple quotes from Brendan showing that data. And here's a breakdown of the report. As you can see, price followed cash flow. Cash flow is now even going up. And we were always confident in this because we had the runway. They had $80 billion of gross, $60 billion in net cash. They bought back a ton of stock at the lows, unlike most American CEOs, which buy at the highs so they can dump out their own shares. In China, they buy at the lows, which is actually the right thing to do. And now cash flow is recovering on top of it, and the game is on. So you can see all the data here. Go through sector by sector growth between the international, knocking the cover off the ball. Taobao and Tmall, monster business, now growing again. Tmall grew 9%. Taobao and Tmall grew 9%. This is a huge business. Cloud revenue reignited double digits at 13%. AI, as we said, triple-digit growth for the 6th consecutive quarter. So go through all these and go carefully through the conference call and the areas that we've highlighted, and you will see why we are so excited and just getting started, and long way to go here. Etsy, he did an update. All you need to know is this thing is a cash machine. So you're generating the same amount of cash as you were when it was a $300 stock. They just hit record revenues, and you can't give away the stock. So this is going to be another Alibaba. Everyone's going to be selling in the hole. And then when it gets up to 100, 120, everyone's going to be interested. And that's just the way it goes. They're going to turn the corner. This thing is absolutely fine, and they've got everything they need. Strong balance sheet, lots of cash, pretty good leadership, and a niche market. So you can go through our stuff there. Canada Goose, cash flow exploding again. A lot of collabs, had a cold winter. Everything's back on track with that. Pessimism, fear and greed down at 22. This is when you want to be a buyer, not a seller. Be selective, and so on. So great article there. Jeff helped put that all together in a very great way. Earnings, top IBD top 50 growth index, top 30 weights in the last 60 days. The earnings estimates have gone up by double digits, 11% and up 8%. So keep an eye on some of these names that have been battered. Basic materials have gone down. They're still trading in the hole. This is going to start to inflect. So this is where the puck is going to be going on a selective basis. Pay attention to that. Cooper Standard is, for the first time in a long time, seeing insider buying. This is John Mastrocola. He is a director, went into the open markets and bought stock at $15 and $15.26 and $14.55 for $118,000. look, it sounds like a rounding error of lunch money, but for most of these directors, it's not that is a huge amount of money, and so that's a serious token. And then the CFO, who I've met with, a super great guy, went in the market and also bought stock at $15. He bought about 45,000. And if you look at his salary, you will see that that is a meaningful amount of money. So these guys are seeing what we see, and it's a great vote of confidence, and kudos to them. And they're going to make a ton of money, and they absolutely deserve to make a ton of money. And we're super excited to be part of it. Okay, so here's some economic data. We've kind of gone through all that. Earnings were good. Guidance they took down seasonally, which we covered. And finally, we're going to go through our Ask Me Anything from our incredible audience. So for those of you who just tune in for the podcast part, you got all your data, you got all your value. Thank you so much. We'll be back next week, same time, same place. For those of you who love the Ask Me Anything questions, as we go through different companies that audience members want me to take a look at, again, this is all opinion, not advice. Go to Hedge Fund Tips, click on terms, listen to the disclaimer at the end of the video. We're going to start now, so let's kick it off to the second half of an exciting week. Robert Holly. Understand your advanced auto parts projects 7% operating margin. Looks like their average operating margin is around 10.5, given they expect to do below average historic operating margin 2027. It's fair to assume they do below historic average net income margin 3%, which would give them EPS around $4 or $5 a share for 2027. Okay, so 7 to 9 times. Do you expect a profit margin greater than 3? I think you're going to see a lot of synergies, and I do think you're going to. I think they're sandbagging this in the short term. I do think you're going to see higher margins than that. I do think you're going to see a hockey stick inflection of revenues that they're not even anticipating, and then the synergies of the hub and spoke as they get a concentrated foothold versus this disparate foothold on the West Coast. We like this story. We agree with the bull thesis that we went through earlier, and we thank you for the question. This, for me, with my eyes closed, my view is that it's at least a double from recent levels, and I think it's going to be a lot more as Shane O'Kelly just straightens it out. We've kind of done all the cleanup now, so we're basically cleared out the mess, destocked, got the synergies going, and now I think we're going to move into growth. And don't forget, they are expanding stores still in those areas. And now the balance sheet, you had, when this stock dropped from, $225, buying it in the 40s, it looked like there was no end in sight. This is just what happens. It has these cyclical bottoms every handful of years. They come in and they fix it. This will be no different. And now they've got a better leader than they've ever had in history. So if this was, a double, I think happens with the eyes closed. I think this could be a lot more than that if he can execute 50% on what he's saying. I think they're going to catch a lot of tailwinds that they're not expecting. They're making projections on the basis of a very pessimistic outlook right now. And I think as things get better, those estimates are going to go up, just like with the analysts. So we like this one, and we love the fact that they've de-risked the balance sheet massively from when we initiated the position. Steve Franks, correct me if I'm wrong. What the hell is this? Advanced auto parts, same questions, same theme. Don't send questions in twice, ladies and gentlemen, but thank you for sending the question. Theo Dumont, well done on Rolls-Royce. Again, great turnaround call from Turnaround Tom. On Etsy, I see the value play. However, it's not fully clear to me how they'll be able to protect against larger, more. Amazon already tried to knock them off, and they shut the business down. So if you research the company, you'll find that Amazon did try to take their business, and they realized that they couldn't compete against them in their niche market, and that was the end of that. So that's not a reason to be pessimistic. Dustin D., what are your thoughts on the recent memo? Trump suggesting he could prevent investment in Chinese AI companies. Do you worry about Alibaba being delisted or potentially becoming completely restricted investment? like Russian ADRs. China's too big of an economy for him to do that. But yes, I worry about everything all day long. That's what my clients pay me to do, is worry nonstop, so they can just make money and go out and golf and go to the beach and enjoy life because they deserve it, because they built incredible businesses or real estate investment portfolios or whatever they did. They pay me to stay up and worry about it. And that's why, like, if I had my druthers, Alibaba would be 100% of the portfolio. I would never do that because we have position limits, and we max out our position limit, which is much lower than 100%. That's why we own 8, 10, 12 companies. Why? Because there can always be something that you don't know. But our two filter criteria is, number one, if any one position in the portfolio went to zero, would they take us out on a stretcher? The answer is no. And number two is, would the remaining positions, 9, 10 positions, be enough to still outperform and reach our IRR hurdle? And the answer is yes. So yeah, that's always a risk, and that's why it was trading at such a discount. You don't know anything that anyone else isn't thinking about. The key is the dynamic has changed. It's gone from an administration that was everything about China is wrong, let's not communicate, to let's make a deal, pay me. I mean, that's all Trump wants. Pay me. Do a deal for the US consumers where we're either getting tariffs or we're getting advantages that we didn't have. And if you help us make money, the door is open. And if you screw with us, then we will take you down. And the direction it's going is, let's make money together. And that's what you saw. So I think that could be a negotiating chip, but I think that's in the rearview mirror. People have been worried about ADRs since NetEase in 2000. Every 2 years, when the market's down, people worry about delisting. When the market's up, no one cares. And it just keeps happening over and over and over. So maybe one day that will change, but that's how you manage your risk. You can never be 100% certain about anything, but you play your odds. When you're buying tremendous amount of value for a low amount of price, good things happen over time when they're good assets, and that's what we continue to do. And why we do it in more than one company is because anything is possible, and that's how you hedge against it, by sizing. Simon Stasinas, thoughts on Western Union? We covered that. Not a business we're interested in. Numbers look good. It's just not a business we want to be involved in. It probably works as a trade, but maybe you get a double if everything goes perfect. But more likely than not, it's dead money in a value trap. Ruben Fernandez, thoughts on Honeywell? Elliott involved with $5 billion stake. So he's involved in Crown Castle too. What has that done? Nothing yet. All right, so let's do this. Honeywell, I generally like, but I don't think it's come down enough. I covered this 2 weeks ago. No, I'm not a buyer here. Delvis Long, great podcast as always. Want to ask you about Baidu. Weren't that interested in Baidu, given about it. While Baidu has remained relatively stagnant, do you see potential opportunity here? Yeah, it's just going to take longer, and your upside is going to be less. All of them are going to work, and the bigger they are, the more security you have. So I'm not against that one, but it's second or third best. I want best. Daniel Borkman, you mentioned EL various times. Okay, so he's asking about the PE. That is the exact wrong question. And a lot of people get faked out by this. Is what you have to look at is normalized earnings. When a stock is down 50 or 60 or 70%, it's obvious that earnings are either negative. Look, what's your PE multiple if the company earns 1 cent? Your PE multiple could be 1 million, okay? And the problem is when you look at the turnaround and you look at what normalized earnings is, i.e., what were earnings the last 10 years and what's the growth rate, and take out the aberration and see what it looks like 3 to 5 years out, then the multiple starts to look like 6 times, 7 times, 8 times, 9 times, and then you're getting a bargain. So then you just have to be damn sure, number one, balance sheet is good. Number two, there's still cash flow or a strong balance sheet to give them enough runway to execute the turnaround plan to get back to normalized earnings, or sometimes greater than normalized earnings, then get the multiple re-rating, then get your double or triple, and then go play 18 holes. Jack Z. Tom, was wondering your thoughts on Canadian cannabis company Kronos Group. I hate these stocks. I hate everything about them. This is where money goes to die. That said, there's probably going to be a trade in them. When they turn hard, but gambling is not the game that I play. and they continue to lose money. Simon, don't send me questions twice. Thank you for sending it once, though. I will not respond, by the way, to any of your AMAs. I just answer them live. I don't like send you a personal email like, thank you for sending me. I can't do that. So send in your question. I will answer it on the call. Okay. And very grateful for doing it. Okay. So here is Theo Dumont is asking about Albemarle, a bunch of words, basically saying, what if it doesn't work? Here's the bottom line with Albemarle. Okay. Has nothing to do with global EV demand. Has something to do with China EV demand. Global stock is 40 million. It's going to 120 million over the next 3 to 4 years. That's going to be largely delivered by an artificially demand-generated economy by government subsidy from China, number one. Number two, the cure to high prices is high prices. Lithium goes through cycles. Albemarle does this every cycle. The good news is it's one of the greatest players. So when they cut production and they have $3.5 billion of liquidity, they can wait a year or two for all the smaller players to go out of business and then buy up their assets for pennies on the dollar. And that's why you see, even before EVs existed, every 5 years, the stock crashes 60%, 70%, and then it doubles and triples over the next few years, over and over and over. And that's with EVs, without EVs, whatever. The same thing's going to happen now. The difference is they have better liquidity. They're in a stronger position than they've ever been in. And there is this tailwind of this artificially subsidized market, which is going to continue to grow. Grant Carruthers, thoughts on CCI, delaying reporting. I don't care. I know what the assets are. They're reporting in March, and it probably means they've got some more stuff to say, which is good news, not bad news. So perfectly fine with that. Stephen Frampton asks, West Shore Pharmaceutical. And by the way, Stephen does an incredible job with all of our videos, just as Jeff does an incredible job with a lot of our admin and posts and helping now with articles and all the great things that you guys are taking advantage of. WST. Yeah, so I don't like to make bets on... So it's in pharmaceutical packaging and delivery systems. Let's take a closer look. All right, so cash flow has followed price and revenues. So you just have to be damn sure what is the catalyst for this to turn around. And the answer is that's work to be done. But for me, revenues are declining, cash flows are declining, gross margins are declining, and it hasn't come down that much. I mean, it's down. Let me just see here. So when I get involved in a stock, I have to have at least a double or triple in a few years. And this is like, if everything goes right, I mean, maybe I would get a double. And I think it's just starting to break down. This is going to take a half a year to probably build a base. So no, too early, but probably right idea. You're just too early and the price is too high. Do send it back when it's in the hundreds, probably like 175, 150, and we'll take another look and see what it looks like. But on the right track, just a little early, buddy. Dominic Harlan wanted to say, I love your podcast, been a long time listener. Had a question about option spreads, blah, blah, blah. Okay. Some of that is proprietary and reserved for the benefit of our clients. We have covered a lot of it in the past. So we do, depending on the type of the account, we do long dated spreads, we do in the monies, and there's a lot that goes into it in terms of implied volatility and pricing. And expectations about where we see the price and by when, and then you got to time it. So we're going to leave a lot of that benefit to our money management clients because they pay for it. And I'll leave it at that. But, a good place to start is in the Hedge Fund Tips member section. There are some book recommendations that are a good place to start to learn the Greeks and start to get an understanding. That world probably takes about 3 years of understanding and then 3 years of practice to be competent, and then probably 8 to 10 years to be an expert. So I would just buy good stocks when they're down and get your doubles and triples in 3 to 5 years and don't think about it, and use low leverage is the name of the game. John Phillips, QXO is trading at blah, 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 5 billion in cash. Buying cash at a discount? No, because there's a burn and your numbers are wrong. Nick Davis, thoughts on Parsons Corp? Always double check your numbers with the source materials, the public filings. Don't just trust some secondhand. Parsons, this is a broken momentum stock. It is not going to bottom anytime soon, in my opinion. I don't even need to look at the financials. Matt Tumba, Luck and Coffee. This was a accounting fraud. So even if that went through bankruptcy, I just never trust those companies after that. So I'm going to just leave it at that. It might work, but I don't take company and country risk, and that has both. So Douglas Grant, thank you for all that you do. I listen to your show religiously every week. You mentioned that you do not really like recreational vehicle businesses. I like recreational vehicles. I just don't like the businesses. Harley Davidson, no. No. Not a good business. Never been a good business. Might be a trading vehicle. Let's just see here. I mean, the stock has done nothing in 30 years. Why would anything change? I mean, this is you can't make this up. So hard pass. As a trade, you could probably trade it up to 40, but who knows? Gasper, could you take a look at BASF and Dow? Dow we've already covered. We generally like chemicals here. I'm going to pass on that one. BASF. There are other better chemical plays, which we've covered in recent weeks. Go back to the AMAs. BASF, let's take a look. I don't think there's enough upside in this one, even if you get a recovery, but I'll just do a quick, hold on. Nah, I mean, just show me how this is turning around. I mean, these revenues have collapsed and stock price is basically the same. I don't like that. Lee Foster. AMA question for the Oracle of the OC. That's hysterical. Okay. Would you check out the Stock Gaming Realms GMRL, UK-based gaming company, mobile gaming software? I hate that business because it's a hits business and I can't predict the hits, but I'll take a quick look at it. Gaming Realms. Yeah, I mean, cash flows are rising, revenues are rising, but prices rise as well. So, GMR.L. All right, well, you can see the chart here. I mean, just tell me that they're going to keep hitting on all cylinders and I'll tell you to buy the stock. I mean, this thing looks like it's up a lot in anticipation of what has happened. The question is whether they can keep it happening, and I can never guess on those businesses, so I just stay away. It's like betting on a speculative tech company. Are they going to get the next hit? Ville Vahasari, Helios Towers, cell phone tower REIT in emerging markets. HTWS. So they've been negative cash flow. It looks like they're starting to recover. This is too early for me, and by the time I'm ready, it's probably going to be pricing it in. I don't like this negative cash flow story. And this looks a little bit like a promote. I'm going to pass. I think you're right from an objective point of view, but I think there's too many risks. Travis Monk. Okay, so his question is, why are there changes so late, like gifting and all the things that they're doing to turn around the company? Is because they caught lightning in a bottle, and they caught everyone at home who wanted to produce stuff when they were doing nothing and wanted to buy stuff when they were doing nothing, and everyone got free money. And the fact that they've been able to grow cash flow back to those levels of once in 100-year opportunities for that type of business is a miracle. So now they've got to catch up and innovate consistent with everything they've been able to do. And that answers your question. Could they have done better? Yes. But if they had done better, would we have had the opportunity to buy the stock down ETSY? I mean, we bought this thing down 85%. So, and cash flow is now exceeding the levels it was when it was a $300 stock. So there's not a whole lot to think about here. I mean, basically the revenues could drop 20-something%, and cash flow could drop meaningfully more, and this would still be a cheap stock. And instead, they're actually doing all this stuff to re-accelerate growth, and they are in 2 out of 3 of their platforms and hit record revenues. So my margin of safety is intact here. They've already priced in worse things happening than much worse things happen that have happened, and they've given zero credit for the good things that are happening. And those are the type of opportunities we like with asymmetry. Michael Ozarek. Hi, Tom. Your podcasts have helped me understand the behavior of the stock market more than you can imagine. Question. How do you reach a value for a brand premium over intrinsic value? I give zero credit for the brand premium. I look at the performance of the business, and that tells me how valuable the brand is and whether they have a moat or not, because I can see what type of returns on invested capital. And if they get above market returns on invested capital, that means they have a above market value to their brand moat. So I don't need to guess what it's worth. I just need to look at what's the price and what do I get. And if there's a divergence between the intrinsic value I get and the price that I pay, I'm down, and we make it a position, and we do ride the turnaround. They don't call me Turnaround Tom for nothing. Danny Chan. Okay, for an internship. Danny, I did respond to your email. I don't know if you got it, so just double check. Maybe it went to spam. Want to get your opinion on Chewy. Pet food business is a chronic loser, but I think this one's going to work. You know, it's always the same story, and it's already rebounded. So if you get a pullback to 30 or 25, I think this one's interesting, but I couldn't get enough conviction to buy it in client accounts because it's just not a sleep at night thing. This is more speculative. And I was a little worried about self-dealing with the ownership, et cetera, but I like it. I mean, I like it on a objective numbers basis. I'm cautious on the business it is, just like recreational vehicles businesses. I like the business. I like the objective numbers, but I just know they're shit cyclical businesses that always fail. So kind of like miners. So I get the theme. Everyone loves their pets. I mean, here in Orange County by the beach, everyone's pushing strollers. It's like, wow, everyone's having babies. And then you look under the thing. They're literally pushing their dogs in a stroller. You can't make this stuff up. I mean, like, it's unreal. So it's unbelievable. I think you're right. I think this thing is run up 3x already. So you missed it. And, you know, if it gets back into the mid 20s and the fundamentals continue to look good, then revisit it. But you're late on this one, and your thinking on it is correct. And that's it. We're done for today. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.